What if I told you there's a portfolio designed to survive anything? A strategy built to carry you through inflation, recession, market booms, and financial crashes without you needing to predict what's coming next. It's called the All-Weather Portfolio, created by Ray Dalio at Bridgewater Associates. But how does it actually perform in practice? And how does it stack up against the classic 60-40 portfolio, the workhouse of retirement planning, and against a simple do-it-yourself all-weather ETF version that anyone can build at home? Hello, fellow compounders. I'm your host, Dennis Chen, former hedge fund manager, CFA charter holder, and Wharton MBA. On this channel, we focus on proven long-term investing strategies that can help you build lasting wealth. Today, we're putting three portfolios head to head. Number one, Ray Dalio's original all-weather portfolio. Number two, the classic 60-40 stock bond portfolio. And number three, a do-it-yourself all-weather ETF portfolio that you can actually build yourself at home. Before we dive in, here's an important disclaimer I need to read out. This video is for educational and entertainment purposes only. It is not financial, investment, or tax advice. All takers and examples are hypothetical and for illustration only. I'm sharing general information and examples, not recommendations tailored to you. Investing involves risk, including possible loss of principal. Past performance does not guarantee future results. Your situation is unique. Always do your own research and consult a qualified financial professional before making any decisions. All right, let's dive in. Segment 1, the background of all-weather. To understand the all-weather portfolio, you need to understand where it came from. Ray Dalio founded Bridgewater Associates in 1975. By early 1990s, Bridgewater was advising pension funds and sovereign wealth funds. Dalio noticed a problem. Most portfolios were built for just one environment: steady growth and low inflation. But history showed that the economy doesn't stay in one mode forever. Instead, Dalio framed it as a 2x2 matrix, which Bridgewater has published in its research and which Dalio describes in his books, Principles for Navigating Big Debt Crisis. Here are the two axes. One axis is growth. It's either rising or falling. And the other axis is inflation. It's either rising or falling. That creates a 2x2 matrix, 4 quadrants, or what Dalio calls the 4 economic seasons. It's rising growth with falling inflation. This favors stocks because companies thrive in booming economies with low inflation. The next quadrant is falling growth with falling inflation. This favors long-term bonds, which do well when growth slows and interest rates decline. The next quadrant is rising growth with rising inflations. This favors commodities because resource prices surge when demand and costs rise together. And then the last quadrant is falling growth with rising inflation, or stagflation. This favors gold and other hard assets, which hold value when both stocks and bonds are suffering. Dalio's insight was simple but powerful. You don't need to predict which of these quadrants will show up next. If you diversify across all 4, some part of your portfolio will always be working. That's the foundation of the all-weather portfolio. But all-weather wasn't created in a vacuum. To appreciate it fully, you need to see what it's competing against: the old reliable 60-40 portfolio. Segment 2, the classic 60-40 portfolio. The 60-40 portfolio, that is 60% stocks, 40% bonds, has been the cornerstone of retirement investing for decades. Why? Because stocks are the growth engine, bonds add income, and historically they offset stock market crashes. Together, they give you much of the upside with fewer gut-wrenching drawdowns. It worked especially well during the bond bull market of the 1980s through the 2010s, when interest rates steadily declined. But here's the catch. The 60-40 assumes stocks and bonds move in opposite directions. When both fall together, as they did in 2022, the 60-40 can take big losses. That's the exact vulnerability that the all-weather portfolio was built to address. So now that we know the challenger and the incumbent, let's put them all in the same playing field alongside our all-weather do-it-yourself version. Segment 3, the 3 portfolios. Ray Dalio's all-weather portfolio, portfolio number 1, uses 30% US stocks, we'll use BTI, 40% long-term treasuries, TLT, 15% intermediate treasuries, IEI, 7.5% broad commodities, DVC, and 7.5% gold, GLD. The classic 60-40 portfolio number 2. That's 60% US stocks, we'll use VTI, and 40% US bonds, VND. The do-it-yourself all-weather portfolio number 3. That's 40% US stocks, VTI, 20% high dividend yield stocks, we'll use VYM, 20% US bonds, VND, 10% Treasury inflation protected securities, will use TIP, and 10% gold, GLD. But what exactly is the do-it-yourself all-weather? And why was it built differently? Let's dig deeper. Segment 3B. What is the do-it-yourself all-weather? The do-it-yourself all-weather portfolio is a retail-friendly version of Dalio's concept, but entirely built with low-cost ETFs. It is designed to capture diversification across economic seasons while keeping things simple and accessible. Here's how it works. VTI provides broad US equity exposure, the growth engine. BMY tilts towards dividend-paying companies, adding income and defensive quality. BND is the stabilizer, the bond ballast. TIP protects directly against inflation, and GLD provides the crisis and inflation hedge that commodities once played in Dalio's version. The do-it-yourself version uses gold instead of broad commodity basket because gold is easier to own, it's more tax efficient, and highly liquid. Think of it as a crossover SUV in a vehicle analogy. It's more versatile than the 6040 sedan, more accessible than Dalio's institutional all-terrain vehicle, and designed for investors who want resilience without complexity. Now let's see how these three strategies performed over 3 decades backtesting. The results might surprise you. Segment 4, the backtest results. We used lazyportfolioetf.com for the portfolio backtest and simulation. All results or total returns with annual rebalancing covering September 1995 through August 2025 using ETFs as proxies. Here are the results. Ray Dalio's all-weather portfolio. The CAGR, the compound annual growth rate, is 7.35% over this period at 30 years. Volatility is 7.45%. The max drawdown was negative 20.6%, and it took 42 months to recover from the lowest point. For the classic 60/40 portfolio, the CAGR was 8.28%, a little better than the all-weather. The volatility was 9.68%. The max drawdown was minus 30.6%, and it took 36 months to recover. The do-it-yourself all-weather had a CAGR of 8.61%, volatility of 9.55%, a max drawdown of negative 30.3%, and it took 30 months to recover. Important reminder, these are backtested simulations using ETFs as stand-ins for Dalio's institutional portfolio. Backtests can be useful, but past performance does not guarantee future results. So, who's the winner? Let's unpack what these numbers really mean. Segment 5, interpreting the results. Here's the story behind the stats. Dalio's all-weather, the smoothest ride, lowest volatility, smallest drawdowns, but lowest returns. The 60/40 portfolio, higher returns, but bumpier and deeper crashes. The do-it-yourself all-weather, best CAGR, faster recovery, but drawdowns similar to the 60/40. So, want resilience? Dalio's all-weather shines. Want raw returns? The 60/40 works. Want middle of the ground? The do-it-yourself is compelling. But numbers alone don't tell the full story. Let's stress test these portfolios in actual crisis. Segment 6, case studies. In the 2008 financial crisis, the 60/40 fell over 30%. Dalio's all-weather lost about 20%, and the do-it-yourself dropped hard, but recovered faster than the 60/40. In the 2022 inflation shock, stocks and bonds both fell, so the 60/40 took a beating. Dalio's all-weather also struggled due to the bonds, and the do-it-yourself with golds and tips did slightly better, but still declined. The lesson is that no allocation is invincible. Each has strengths depending on the terrain. So, is the do-it-yourself all-weather truly the best of both worlds, or just another compromise? Let's weigh the pros and cons. Segment 7, pros and cons of the do-it-yourself all-weather. Here are the pros. It has the highest CAGR in the backtest. It has diversification across growth, dividends, bonds, inflation, and gold, and it's easy to implement with 5 ETFs. It has the fastest recovery from drawdowns. The cons are that it's not as smooth as Dalio's original. Its volatility is similar to the 60/40. It's still exposed when both stocks and bonds fall, and it needs annual rebalancing. So, what's the bottom line? Which portfolio should you actually choose? Let's wrap it up. Segment 8, key takeaways. So here's the takeaway. If you want peace of mind, Dalio's all-weather portfolio is your friend. If you want growth and can stomach some volatility, the 60/40 is a solid contender. And if you want practicality with strong long-term returns, the do-it-yourself all-weather makes a strong case. Here's a car analogy revisited. The 60/40 portfolio is like the family sedan. It's reliable on highways, but struggles off-road. The Dalio all-weather portfolio is like an all-terrain vehicle, an ATV. It's steady through mud, snow, and off trails. And the do-it-yourself all-weather portfolio is like a crossover SUV. It's more versatile than the sedan, it's more accessible than the ATV, but it's not indestructible. If you found this breakdown helpful, please give this video a like and subscribe for more smart investing insights. And if you want to go deeper, join our Always Be Compounding online community. Inside, we meet several times a month in Coffee with the Chief Compounder, a casual live Q&A where you can ask me anything about investing, asset allocation, or compounding strategies. Use the code ONEFREECOFFEE for your first month free. And remember, the key to building wealth is to always be compounding. See you in the next video. Take care.